For the reducing balance method, you apply the rate to the net book value. But you see, in the first year, you might have not charged any depreciation. That is why in the first year, it is on the cost. Because in the first year, the accumulated depreciation will be 0. Okay, so the net book value would be equal to the cost. So please note that for me. So without wasting time, let's take an illustration and see how it works. So Ishmael purchased a machine for 7 million cedis on 1st January 2000. He decided to provide for depreciation at a rate of 20% per annum on the reducing balance method. So what is the accumulated depreciation on the machine at the end of the December 2002? The B is what is the amount of provision for depreciation charge for the year 2002? Then what is the net book value? Now, because of the peculiar nature of this method, it is very important that you calculate the depreciations for the years separately before you even begin to look at the sub questions given. So let's look at our suggested solution. We need to acknowledge the cost of the asset, which is given as 7 million. And we also know the rate, which is 20%. And most importantly, you should always ascertain the date on which the asset was acquired. Under provision for depreciation, date is very, very important. Okay, so we need to reckon that the asset was bought or purchased on 1st January 2000. Then the method, of course, is reducing balance. So let's look at how you go about it. So it is expected that we calculate the depreciation for the year 2000, calculate for the year 2001, and calculate for the year 2002, as well as 2003. Simply because we have questions that borders about all these years, 2002 and 2003, right? Okay, so you can do a simple table or how you'd want to do it. Emphasis is on the fact that you'd have to calculate the depreciation for each year. So let's look at the first year, which is the year 2000. We are going to apply the rate, which is 20%, on the cost of the asset, 7 million. And that is going to give us 1,400,000. So in the first year, under this reducing balance method, the rate is applied on the cost. And the reason is that in the first year, the net book value is equal to the cost. Now let's go to the second year, which is 2001. So in the second year, you would appreciate that we have already depreciated the assets at this value, 1,400 in the first year. So it only makes sense for you to say that your net book value will be equal to the cost, which is 7 million, minus the previous depreciation, which is the accumulated depreciation, which eventually is 1,400,000. Okay. So I have done that calculation here, the 7 million minus the 1,400,000. So you get a net book value of 5,600,000. So in the second year, you apply the rate on the net book value. Please, is that okay? Can I continue? Okay, I believe we can move on. So in the second year, it's going to be 20% on the 5,600,000, which is the net book value of the asset as at that time. And so when we do the calculation, we are going to get a depreciation of 1,120,000. In the third year, which is the year 2002, this is what you have to do. So you have to apply the rate on the net book value. So at that time, you'd all agree that the net book value will be the cost, 7 million, minus the depreciation we charge in the first year, which is 1,400,000, minus the depreciation we charge in the second year, which is 1,120,000. So when we do the math, we are going to arrive at 4,480,000 as the net book value at the end of the second year. So if you are getting the excerpts of this under the reducing balance method, you have to be applying the rate on the net book value. And what is net book value? The cost minus the previous depreciations all added together, which is the accumulated depreciation. So let's look at the last year, which is 2003. So it's also going to be 20% on the net book value, which is the cost minus all the previous depreciations we have been charging. So I think in the third year, the depreciation was 896,000. So we would less that 1, 2. And the net book value would be 3,584,000. We then apply the rate on it, and we would arrive at a depreciation of 716,800. Okay. So when you have done your depreciation calculation, then you can now focus on the questions that were given to be answered. So the first one, which is the A, was asking about the accumulated depreciation on the machine at the end of December 2002. So, okay, Mommy, you have a question?
Please, as I was doing the calculation,
Yeah.
when I multiplied the year 2002, the
Okay.
20% and the 4,040, and
Yeah.
the answer I got, I added it to the 2,520. I didn't get 3,416.
Oh, okay. So what did you get for the 20% on the 4,480? Well, I'm keeping 3 zeros up there. That's why you've seen 4,000 instead of 4 millions.
Okay, wait, I've realized my mistake. Sorry.
Okay, you've seen the mistake?
Yes, please.
Okay, so any other question or any confusion I have to deal with? Okay, that's great. Now, if you want to follow the table I have prepared, then you see you can have columns for the years, the annual depreciation charge, where you apply the rate on the net book value. Then you do your accumulated depreciation. Okay, so you see for the first year, this will be the accumulated depreciation. The second year is going to be the first year's depreciation plus the second year's depreciation. That is how come you have this 2,520. In the third year, 2002, the depreciation is 896. So when you add the 3, you should arrive at the 3,460. So you can do that as well. Okay. So I believe we can answer the question on the first part, which is A. So the accumulated depreciation at the end of December 2002, I think that is 3,416,000. Okay. So when you're able to do the table, the question becomes a bit simple. The B says, what is the amount of provision for depreciation charged for the year 2002. So they're only asking how much depreciation we charged in the year 2002. And I think that was the 896,000. And then the last part says, what is the net book value of the machine at the beginning of 2003? You have to be very careful. Yeah, Ella, I'll come to you. Let me wrap up on this point. You have to be careful when they ask you about the net book value at the beginning and at the end. So at the beginning of 2003 would be at the end of 2002. Okay, so you go to the end of 2002, and of course you can get your net book value as the cost minus all the previous depreciations, and you'd have a net book value of 3,584,000. Okay, Prof. Ella, let me take your question.
Okay, so please, I understand provision for bad debt as maybe the amount you estimated that will be your bad debt, but now I don't get it. Is it the same for provision for depreciation?
Okay, so in answering your question, all the provisions in accounting are estimates. Okay, we predict that this is the possible loss. Yeah, this is the possible loss that we are going to make. Hence, we should set an amount against our profit to cover that possible loss. So for the case of bad debt, provision for bad debt, we are predicting that our debtors may not be able to settle all their debts. So we just estimate. All of these are estimates. But in doing estimation, you need some, standardized method to calculate, certain figures. Yeah, go ahead.
Okay, sorry. I was solving a past question once, and they provided provision for bad debt, and and there was also provision for depreciation,
Okay.
but the provision for bad debt was like more than the bad debt. It's like more than the bad debt itself. So they subtracted it, so it became a revenue. But they added the provision for depreciation. I didn't really understand it.
Wow, I may have to see that particular question to be able to give you a very good answer on that. But these two concepts are different because, provision for depreciation is on our fixed tangible asset, whilst provision for bad debt is on our debtors, which is a current asset. So if they were adding and lessing certain figures, I may have to see that particular question. Well, in your discussion of the final account, I want to believe you were given the specific thing you have to do under the final account regarding provision for bad debt and provision for depreciation. Okay, but in order for us not to be jumping the gun, let's relax and take our time. I'm sure when we get to provision for bad debt, all these little confusion will be cleared. Okay. Any other question? Any other question from any of us? Amma, Mame, and Kennedy. Are we okay? Okay, so please, the major highlight I want you to get under the reducing balance method is that the rate is applied on the net book value. Okay, but in the first year, the net book value is equal to the cost. So in the first year, you can say that the depreciation rate will be applied on the cost. But in the subsequent years, you apply the rate on the net book value. And we have all experienced that the net book value is the cost minus previous depreciations you have charged. Okay, I believe we can look at this second question. So we have here The purchase price of a machine, 7,000. Freight to move machine to plant, 350. Assembly cost, 300. Then we are given estimated useful life, 5 years. Using the reducing balance method of depreciation at 30%. What is the depreciation charge for the second year? Now, I brought in this question for us to appreciate. You remember yesterday when we were looking at the factors to consider in measuring depreciation, the first one was the cost of the asset, right? And I told you that the cost of an asset is not only the purchase price, it includes any direct cost like transportation, installation, testing, any cost that ensures that the asset is ready for use. So in this illustration, you see that we are given the purchase price of the machine, 7,000. We are also given freight to move the machine to plant. So this is a transportation. Freight is an insurance against carrying goods on the sea, right? So it is a transportation of the machine from the manufacturer to the business plant. And a plant is where you set up a machine to be able to function and work properly. Then we are also given assembly costs. Okay, you can only use the machine if it has been assembled. So this cost is part of the cost of the machine. So in solving this question, you have to first of all determine the cost of the asset as follows. So you would add the purchase price to the transportation and then to the assembly cost. So we are going to get a total cost of 7,650,000. So please, when you are solving questions, watch out for some of these things to be able to determine the cost of the asset. If there's a confusion there, let me explain more or cite more examples. I think yesterday I used a very simple example that if you go to Melcom and you buy a television, how much you pay at Melcom is the purchase price. You'd have to carry the TV from Melcom to your room, right? The driver will take you some transportation cost. When you get the television to your room, you need an expert to install it for you, as in fix it for you and test. If you want to even install DSTV or multi-TV whatsoever, it is the technician who is going to fix the dish, do the tuning and all that. You pay the person. Okay. So all these expenses or these payments should be part of the cost of the television, simply because you had to pay for those expenses to be able to get the television ready for use. I believe I've been able to make a lot of sense. Okay, so the cost of the asset determined. Now, our rate of depreciation is 30%. So let's look at how to calculate the depreciation using the reducing balance method, and we have been given a rate 30%. So my dear ladies and gentlemen, now we have two gentlemen here. Please, can any of you calculate the depreciation for the first year? The rate is 30% and the cost is 7,650. So what will be the depreciation in the first year? Oh, do I need to call somebody now? Okay, Prof. Kenton. Let me call Prof. Kenton. I think Prof. Kenton says he's going to He's going to eat something before he comes to answer. Oh, who is ready? Nobody is ready. Oh, well, let me do it myself since my students are not interested. Let me do it myself. Okay, so for the first year, the depreciation will be the 30% on the cost of the asset, right? So we're going to have 2,295 as the depreciation for the first year. So can we try the second year? Remember, it's reducing balance method. So in the second year, you need the cost of the asset minus the previous depreciation you have charged. So in this case, it will be the 7,650 minus the 2,295. So we are going to get a net book value of 5,355. So in the second year, you apply the rate on this net book value. Okay, and I think we would arrive at a depreciation of 1,606,050, 606.50. And I think the question was saying that we should calculate the depreciation for the second year, right? So the depreciation for the second year is 1,606.50. Please, are we okay?
Yes, please.
Well, so let's take another one. Let me see if I can type a short question for us to look at how you are going to work around it. So the cost of vehicle is given as $50,000. It was acquired on 1st January 2006. Rate of depreciation is 10% per annum, reducing balance method. Calculate the following. So A, the depreciation for the year 2008, for the year 2008. B, the net book value at the beginning of the year 2009. Okay, so ladies and gentlemen, have a bite on this short and simple question, I believe. We have 5 minutes to do this. So your clock is ticking. Start work. Please, I hope you got the question and you're okay with it. The cost of the vehicle is given as $50,000. It was acquired on 1st January 2006. The rate of depreciation is 10% per annum, reducing balance method. So you have to calculate the depreciation for the year 2008 and then the net book value at the beginning of the year 2009. So like you did yesterday, when you are done, you can put your answer in the chat for me. And as you are working, please, it's like some of you have still not activated your personal pages. This is what I want to do. I think when you are done with your calculation or your working, take a snapshot and put it in the private page. Okay, so I'm taking a screenshot of this question into the group, just if you would need it. But please make sure you submit. Otherwise, we are not starting the second session. I want all of you to submit onto your private pages. Then we rejoin to look at the second session. We have 3 minutes for this session to end. Okay, so let me take a shot into the group. But so far, is none of you done with it? Okay. So if you are done, take a shot and put it on the personal page. So I think Prof. Ella has hers, so she'll put it there. Prof. Yatu has it. Kenton has it. I think all of you have it. You just have to activate it, especially for yeah, Kennedy has it previously. So okay, so this session is ending. Please submit them quickly so that we can resume in the second session and continue. Thank you very much.